So really what we're talking about, what we're trying to accomplish by selling these calls, well, first of all, I'll just go ahead, relates to capturing the time premium over the term. In other words, what happens is over the life of this option, what's happening is the part that relates to the life, the value that relates to that is disappearing because time is passing. But by selling these calls along the way, we're actually capturing some of that time premium along the way.
Right. If you make a premature exercise, you are forfeiting whatever remaining time premium there is.
Yes.
If you exercise early and there's a lot of time remaining and it's a highly volatile stock and the stock's not too far from the exercise price, the amount that you forfeit is quite big.
Yes.
If indeed you have held these things for 9 years and you only have 1 year left, and they give you the right to buy the stock at 20 and it's at 55 and it's not that volatile and pays halfway decent dividend, you may be just as well off by exercising them early, okay, because you delay the tax maybe 1 year.
Yeah.
And you're not, and the forfeiting of the time premium may be very small.
Yes.
So if you want to reduce risk, and you've held them for 9 years and saw the stock go from 20 to 55, you've been assuming a risk quite intelligently, and then you were kind of lucky that it went up that much. So you might just go ahead and exercise them now,
okay, and
take the cash and pay the tax.
Now
but the time
okay,
you don't want to do it is when you got plenty of time remaining,
mm-hmm,
you got a high volatile stock, and the stock's not too much above the exercise price, and therefore has a lot of time premium left, which you would otherwise forfeit.
Okay.
Okay.
Now, what do you give up by hedging?
You give up some potential gain, okay, whether you're buying the puts or you're selling the calls. The amount of gain you give up depends upon how much hedging you do. I actually advise people to start small and do partial hedging, and therefore you always assuming a long position, and you still have this alignment with the company.
Yes.
Even though you only partially hedge.
Yes.
Okay.
Okay. So I think we've covered many of the points that we wanted to highlight here. Again, so let's talk about some of the mechanics as far as how this works.
All right. You just open an account at a brokerage firm. Mm-hmm. Try to find the one that charges you the less commission and the minimum margin requirements, and that you have faith in that a stable outfit. And then you can execute the trades electronically from your computer. Mm-hmm. You don't need to pay a broker, or you might find some wealth managers and investment advisors who know this and are willing to guide you.
Okay, now what sort of, we talked about what you can use for security, but for example, like a percentage or something like that, how does that work as far as how much you require, the margin that you have to put up in order to do this sort of a strategy?
Well, the minimum margin requirement depends upon the exercise price of the calls that you're selling relative to the price of the stock. So, for example, if the stock is trading at 100 and you're selling calls to hedge your employee stock options, that may give you the right to buy the stock at 60. If you sell the calls that have a strike price of 110, the requirement for selling a call that gives a buyer the right to buy 100 shares will be, let's see, would be $1,000. Okay? So it's 10% of the value of the stock. All right, 100 shares of stock that's trading for $100 is worth $10,000. Mm-hmm. If you sell a call and it's an initial opening transaction, the minimum margin requirement is $1,000, which is 10% of the value of the stock.
Okay.
Okay.
Now, when you're doing this, you're getting a premium as well.
Yeah, well, you're collecting the
Yeah.
value of the call that you sell.
So first of all, you have to put up some money. Then you get a premium, and I guess you can recoup
Well,
some. And then,
no,
so where do you end up,
if you-
cash-wise as far as?
if you don't have any stock in the company or
Yeah.
other mutual funds or any assets to put in
Yeah.
there, you're going to have to put up some money from your pocket in order to do this.
Yeah.
And if you don't have any, then you may not be able to do it at all.
Yeah.
Okay. Some of the brokerage firms charge excess margin requirements.
Mm-hmm.
You can find the better ones, and I can mention some names like Trade King or Options House. These people kind of focus on accommodating people that want to trade options, and they'll charge a lesser margin. But you don't want to stretch that up to the ultimate and just put up the minimum, because you could get a movement against you and you get a margin call.
Okay, but I guess what my point is that we're getting some money from selling these options. Okay.
But that's deposited. That has to stay in the account. So you'd have to put up some margin in addition.
You're
to
saying,
you-
okay. So we're not going to end up being cash ahead necessarily.
No, you'll get cash credits to your account. Yeah. But that will have to remain in your brokerage firm account. Plus, you'd have to put up some money for the possibility of you having to pay more for those options than you sold them for. Okay. And
so, but now people are going to be wondering, so how do I end up ahead from all of this? Because now I'm having to deposit this. But I guess the point is that eventually this is going to settle out. And
well, if the stock goes up, your employee stock options are going to increase a lot more than the hedges you did.
Yeah, that's what we hope.
Okay. Yeah. Well, it will, unless you're overselling too many or buying too many puts. But the idea is to effectively make a sale by selling these of the employee stock options by selling the calls.
Yeah.
And as I said, you don't want to lose the total alignment that you have with the stockholders and defeat the purpose of the plan. So you just do it gradually.
Okay. Okay, John. Time to wrap it up.
Okay.
So we're covering a very heavy subject here, folks. I hope you enjoyed this, but I hope you also see, I mean, this is an important subject. There is a way to realize what would otherwise be lost value in stock options. John, thank you so much for coming from Louisiana to be with me today.
I enjoyed it.
It was a real pleasure.
You're a great host, and certainly asked the right questions.
Folks, hope you can join us next time on Financial Insider Weekly.